Good morning, traders. Welcome to the daily wave count update. It's December the 16th, and today we're starting the analysis with the euro. On the euro, we have been following the leg down. So far, the price has been building this accumulation process. So all these leg here seems that is building the accumulation. We have the MACD losing its momentum, while the volume started to increase and increase to finally decrease in this leg down here. However, here the low was quite with a low volume, or average volume, but lower than what we were seeing before. So this is the MACD shows the big guy absorbing, and the volume shows the sellers exhausted. So it's the mix between sellers absorption with exhaustion. And then the price climbs and builds this corrective wave here, where we are looking today for the bullish trade. We started early in the morning with a bullish bias on the euro to probably start to the wave 3. So the other important part, traders, in terms of momentum is that, look, we have here the MACD moving down. However, the price did a significant leg down, so it is not matching the amount of price movement with the MACD. The price moves too much compared to the MACD, so it's a withdrawal of liquidity from the big guy. And the withdrawal of liquidity ends with the price reversing and the price going up. So we have the big guy candle as well showing up there. There are many elements to consider that this could be an interesting reversal, at least to make some profits, at least to start working the euro this week. If the price allows a little bit more, let's suppose that the price rejects and moves lower, we can extend to the wave 2. And actually, that could be better. We have also the change of behavior here, actually, in this level, right? The high between the last two lows. So that's the change of behavior. And the price is holding far from the lows nicely. That's another element from price action. Then we can look for the leg up. When we are checking these markets, we should start with a little bit of analysis before jumping into trading. The beginner starts with the chart, with the indicator, with the trading chart. But that's a bad idea. It's better to gain some context before jumping into the triggers. So spend some time with your chart, a few minutes. If you like to trade the S&P, gold, oil, and stocks, or anything that you like to trade, start with checking your analysis chart before jumping into the trading chart. You should have two layouts. One to analyze the market, could be with Elliott wave. If you like this MACD, the volume, extremely important. If you like, I don't know, the moving average that you like, if you like to use that, your Fibonacci levels, if it's something that you believe that adds value, whatever. But spend some time analyzing the chart and think about it. Could be 2 minutes, could be 3 minutes. You don't need to spend the whole morning thinking on the analysis. Just switch the time frames to have different angles of the information. And once you believe that you are ready, you can jump into the trading chart. For example, traders, we can use the MACD also, saying, okay, if the MACD is under the zero line, it's a bear trend. It's a bear tape. If the MACD line and single line are above the zero line, it's a bullish trend, right? Those kind of concepts also we can use them, because in order to stay in the trends, that could be useful as well. So if you want to write a longer trend, you can say, okay, I'm going to stay in the trend until it crosses the zero line. And this happens, I'm out of my bear trade, for example. Right? That type of thing also could be used along with the MACD. The MACD has many ways of using it, because there are many details that we can see around the MACD. So it's momentum. So the three elements that we are checking here, well, actually four, but three in terms of price, volume, and momentum. The price is the most important one, right? Because it's to see how the supply and demand is happening. Volume, to analyze the effort and the result with the price. Right? So volume is to see the effort that the retail participants, not the big guy, are putting into their ideas. And momentum is to reveal the big guy. Is to reveal if we have, for example, a big effort and a poor price and a slow momentum is because the big guy is absorbing. We can also see the withdrawal of liquidities when the momentum increases. So these three elements are going to give us a lot of details to understand better what's going on. And the fourth element is the cycle analysis. Cycle analysis with Elliott wave. Elliott wave, we know that cycles are something that are happening in the markets. That when already happened, in the past, we can easily label them. But when we are live, it's more tricky. So that's why we need to rely on the other elements to try to find on which wave we are likely to be on. Not just a pure Elliott wave, because of course it's impossible to know which is the next wave only thinking on Elliott wave. That's quite a gambling. But when we start adding into the equation the big guy, the volume, the price, the behavior, we are increasing the probability of being in the right side of the trade. And as always, everything under the frame of the good business practices, good business management, in terms of making sure that our resources are being invested efficiently with proper risk management and emotional management and having a whole business around these ideas. Once we have a bias, once we believe that something is going to happen based on what we are seeing that the big guy is likely to be doing, the next step in the process is jumping into the trading chart. So something that we have already prepared. My trading chart is with the big guy indicator, with the heading line, and the liquidity areas. So once we have all these happening here, we have the next step is looking for the entry point. So today in the morning, this is the trade that we were following today in the Discord. Because look, we have the big guy and the heading line going up. This is one of our best setups. The MACD started to lose momentum. The volume here at the end was increasing above the average, but overall was decreasing. On the bigger picture, lower volume, At the end, we have an increase with the big A candle, that is one of our favorites, at the previous liquidity area that we were watching, the MACD losing momentum, and we got the demand plus. If we were trading the tape signal, that would be here, and that would be the entry point. If we were trading here, for example, that would be a strike. Or, if we had the rule of the MACD, we are not going to trade unless we have a little divergence, not when the maximum point on the MACD has been reached. That would be a filter to avoid this trade. However, adding those type of filters, sometimes the market can finish even with the strongest momentum point, and we can miss those trades. But probably will be better to wait at least a little bit of divergence rather than buying here. So if you include this little rule, in this case, you will be saved. If not, it was a strike. Then, the price starts building a nice leg up. 1-to-1, enough to book profits, probably even before when the tape changed here. But in case that we ignore that signal, the next exit point would be the 1-to-1 around this area. If we were trading with the tape signal, we could have actually the double on the same distance. So it depends on the approach that we were doing, but as always, for the sake of the exercise, I always use the demand plus or the supply plus, and then you can try to improve it. Then we have the price climbing a little bit more, but now we have to be careful with this trade because the heading is starting to sell off along with the big guy. So this is not good. We can consider closing everything at this 1-to-1 or booking some good profits if we want to keep it for longer. Because at this stage, of course, there's a warning, there's a danger. We're seeing the price rejecting this area. So it could be possible distribution. We have the histogram on the MACD losing momentum, and we have the MACD getting ready to cross down the zero line. So it's the signal line, sorry. So of course, those are things to consider. Try to take out from the trade as much as we can. So that's the euro. And if the price makes that leg down, traders, if that's the plan, we can extend to the second wave, and actually it will be a better trade to buy it somewhere here. Let's see, because this start of the leg is not showing good results yet, as we are seeing on lower time frames. There is a big warning that we can have another leg down. The pound, same storyline. I prefer the euro, looks better, and the Aussie looks really good. So let's make the whole exercise here. Everything is about understanding the context from the big guy point of view. That will be the most important part of this process, because understanding what the big guy is doing is key. The price is going down, that's a fact. From this high, the price has been going down. The MACD the same, but eventually the MACD started to go up. The price continues lower, reaching lower lows. However, the MACD is going up. Volume in the bigger picture is decreasing. So we are seeing, after the volume, price, and momentum analysis, the result after this analysis is that the big guy is absorbing the exhausted sellers. Less sellers, poor result on the price. Momentum going up. So the big guy, we can see the big guy from the MACD point of view. It would be one way of seeing the big guy. The big guy can be seen from different perspectives. Liquidity, that is the indicator. The MACD, that is the momentum. So it's the first difference in mathematics between the speed of each leg. That actually is the definition of momentum. So it's more close to the definition to acceleration than to speed, right? And the momentum and the volume, sorry, to know the how many participants are creating these legs. So after seeing all these details, we have the result, and is that we are likely to come back here to the previous high. But this is not enough. This is just analysis. The next step is going into the trading chart to find out if this is a good idea with the indicator. This is just analysis. This is just internal analysis of the price. Now we need to go outside using the indicator and see the trend of the risk. So here, we can go to the Aussie. Let's have a look at the 30-minute chart, the trade that we're going to start following this week. And from this perspective, we can see that actually it's a really good idea. Because look, the heading line is going up along with the big line. It's not the position related to the price. So never use the indicator based on where it's related to the price. That would be a wrong application. You need to use it based on the direction of the line. So scaling and that type of thing is not going to be something that you need to worry about, because the direction always is going to be the same. No matter if I zoom out, the direction is not going to change. Look, the heading going up, the big guy going up. Or if I zoom in a lot and they switch the one below and the other above, the direction is the same. So we don't have to worry about scaling and that type of thing. So the point, traders, here is to start building this narrative and to start looking into these setups. So then we can start trading from here, booking some profits. If we haven't triggered the trade yet, we can wait for a discount. If the price makes a fresh low, we can have a better entry point. But overall, that's going to be the strategy for this week. Here we have, traders, the New Zealand dollar, the Kiwi. Also, same storyline. I think it's better the Aussie, more clear, but we can pick one or the other. And the other is the dollar yen. The dollar yen, traders, has been climbing, and we have to get ready because it's going to be a short trade. I believe is the biggest opportunity. Let me explain you something. When the money flow is going into this direction, like in this case, from the yen to the dollar, markets are expecting tightening in the monetary policy. Tightening in the monetary policy. When the money flow is to the other side, markets are expecting easing on the monetary policy. So this dollar yen moving up equals higher inflation expectations. When the dollar yen is moving down equals lower inflation expectations. So these days, we are seeing that the market is under higher inflation expectations. One of the key concepts in technical analysis is when you are making any certification, one of the key questions is something like this. You just receive the Wall Street magazine, and there is a bull in the front page of your Wall Street magazine. And then they ask, what would you will do with this, just with this information? You will buy stocks, you will sell the stocks. And if you're in a more advanced certification, so they are going to add options. You're going to do this with your options, you're going to cover with that. But in a simple manner, are you going to buy stocks? Are you going to sell the stocks? Are you going to wait? Or this picture is not going to give information? The right answer is selling stocks. Because you always need to be contrarian to the public. Remember that most of the public always is wrong. Close to 90% of the times, they are wrong. So when we have the dollar yen going up, it tells that the inflation expectations are higher. Now, the Fed is coming this week. And this is telling that the market believes that the Fed is not going to decrease the rate. Currently, the rate is between 4.45 and 4.75. So the market believes that the Fed is going to stay there, that the Fed is not going to decrease the rate. However, this is wrong. The Fed is going to decrease the rate by 25 basis points. So actually, on Wednesday, the Fed is going to decrease from 4.5 to 4.25. 4.5. This is going to be the new range on Wednesday. But the market believes that the Fed is not doing anything because inflation expectations are coming up. These traders is a market mistake. When we find the market mistake, we have an edge, we have an opportunity. Yeah, we have to pay some strikes. There is nothing free in this life. Everything comes with a price, and the price as traders are the strikes that we need to pay in order to finally successfully enter a trend. We need to try to reduce the cost of the trade. The cost of the trade is the strikes. In order to reduce the cost of that trade, we need to make sure that once we have one of those entry points, when we have the one-to-one, we need to reduce the risk by booking partial profits or tightening the stop loss. But we need to do something to reduce the cost of the trade. Lower cost of the trade, once we have the payment for our work, we're going to make more money. Of course, it's better to have that type of mindset, but it's just at the cost of the trade. So at the end, traders, if the Fed actually moves the rate down as I am expecting it, of course I could be wrong, but this is my analysis, 4.25 to 4.5, based on the bond markets. Then the price, when the Fed decreases the rate, could make a fast leg down, or it could be before, right? The main plan is that all these guys are trapped. And all these buyers, more buyers at the high, more buyers at the highs, of course, are trapped. So that's going to be the plan. Sometimes we need to wait for the Fed as the excuse to have the price coming down, and sometimes the price starts reacting before. If we survive to the noise, as Wyckoff said, one of the most difficult parts of trading is surviving reactions. Actually, on chapter 10, we see that Wyckoff was telling, that's impossible to survive. Probably Wyckoff had a pretty bad experience trying to stay in the trade. But we have to do it, traders. We have to, because that's the fat tail is the only reason we're going to make some good money at the end. So that's something that we need to try to stay in the trade as much as we can. Okay, so that's from that perspective, and of course the MACD losing momentum and everything. Now when we check the indicator, we have a discount. We have a good discount, traders, because we are seeing the price too expensive related to the heading line, which has been selling, and the big guy as well. Of course, this is a clear picture of application because both lines are going down and the price is too expensive. If the price was coming down, of course, or was already down, then we couldn't have anything. But we have the price going up. That's the setup. So the next step is looking for the trigger. Could be on this time frame, the 30-minute chart, or if we want to accelerate the entry point, we can move to lower time frames, 15 or 5-minute chart. We're going to sell then the dollar yen this week, getting ready for that trade. The next step, the next instrument, is dollar CAD. Dollar CAD also has been climbing, and the same storyline. So inflation expectations are bullish, and the dollar is the same storyline. I believe that all this price action is wrong, so we need to sell it. The euro pound, the same story of other euros going up and starting the corrective wave, and the euro yen keeps climbing, so the same storyline. We need to sell it. The Bitcoin traders, we knew that this was likely. The Bitcoin actually is doing what it should be doing in terms of the risk. Is going up. Is having some trouble when it comes to the previous highs. Look, it comes to the previous high and immediately rejects. I'm sure it's hard to find the buyers at these prices. The Ethereum, time for a discount, and then we continue with the trend. And here we have the S&P. On the S&P traders, last Friday, we were looking for a sell trade. It was a good trade. So we were here looking for the leg down at this high. Although the indicator was telling that the price was likely to drop. The indicator is a powerful way of seeing the liquidity. And we got the entry point, at least in my case, I was able to capture like 3 or 4, 1 to 4, but the trade finished building a 1 to 12 risk-reward ratio. The MACD, as we can see, increased the volume here, telling that the big guy withdraw the liquidity. So buying here, a little bit harder, at least on this time frame. Different to the setup here that we were seeing before the CPI news. Was better, right? The volume increased a lot. Here is Friday's volume. Friday, Thursday, Wednesday, and Tuesday, and Monday. So Monday starts here, increases, decreases on Wednesday, increases on Thursday, and increases on Friday. That was the volume for the week. So we got a strong volume. On Friday, the big guy withdraws the liquidity. We can see that from the MACD as well. And then the price finished the leg at this Elliott wave block and rejected. Today, traders, it seems like the wave 5 is going to be over soon. We're going to check that in a second. And the plan is having a retrace because it's too expensive since we started the session. Has been expensive, different to the euro. At least the euro was cheap. So let's have a look at the trade that we were seeing last Friday. And then let's see what we can do here. Let's have a look at the 5-minute chart then, and let's move into this trade. Also, I have a picture of the Discord setup that we were working on last Friday. So here was the setup. The big guy line was going up. but the heading was clearly going down. So, and the MACD was losing momentum, and the volume was increasing. So that means that the big guy is absorbing the buyers. The heading is telling that the plan from the big guy is a leg down. We don't know how deep it's going to be. We don't know if it's going to be a shy one or a complex one or a deeper one better. Right? We don't know that. But we know that this area, the price is going to be hard to continue higher. So the only thing we can do here is selling. I don't like selling the S&P. I don't like selling the S&P when I'm short. The S&P, I usually book my profits faster than when I'm bullish. But that's just a personal preference gained with experience and after many losses. So the point, traders, is that here we have all the elements for a sell trade, as we were seeing this one on the last Friday class. So we have all the elements there in order to have the price selling. And the worst that could happen is having a strike or a couple of strikes, and the best could be a good trade. Then in this storyline, we got the superclass candle. At least in my case, I got the 1, 2, and 3, enough for me, booking profits at the 1 to 1, and it was enough for me. But it was a great week last week, so I didn't need too much. This was just like an extra for the week, so in my case, it was enough. But then traders, after that thing, the potential hardly to get to stay in the trade because it was Friday and because it was a short. But if someone has nerves of steel to capture all these like down, well, great. The price bounces here, and look at this beauty. I didn't see this one. Look, wow. Look at that thing. And look, the MACD is after this cross here, right after the retrace, opens its mouth, as Bill Williams liked to mention his alligator system. You remember that classical system from Williams? Bill Williams? The alligator was pretty popular in the 80s and 90s. And he said it's an alligator, and when the EMAs are increasing their distance is when the alligator is opening his mouth. It was just to take his comment into this MACD. So the MACD increases the momentum, and then here, process. Right? So here we have many elements. Consider that this could be it. It's a Friday, we're getting closer to noon, it's a 1 to 12 risk reward. I don't know if someone was able to capture the whole move. I only take like 1 to 3 or something like that, like 1 to 4. But of course, this was the potential of the trade. We can have different results. Remember that staying in the trade is the most difficult part that we can do in a setup. The trader believes that the most difficult part is finding the bias or the entry point. And actually, that's the easy part. You know, when the trader says, oh, it's so hard to find a good trade. And you can't imagine how hard it is knowing where to book your profits. That's the most difficult part. The beginner believes that he's setting targets. And of course, it doesn't work like that. So the profit taking is an art of watching price by price and making decisions. If we are too conservative, we are going to close the trade earlier. If we are more aggressive, we are going to close the trade later. Okay, so then traders, we have the price and the MACD showing a divergence, and the big guy is flying. So this, in case, let's say that someone was so like a hero was able to capture all these things. Let's suppose that someone was able to do something like that. And here, look at the divergence. We have divergence, and we have a volume slowing down, and we have the big guy flying to the other side, and we already have some stop in action. So there are many points, many angles to consider that this is it. This is it. So if not, well, probably a stop loss or something will catch the trader higher. And the price goes up, and that was the Friday session. Quite interesting. Indicator is extremely powerful, traders, because it gives us an additional edge. Today, traders, is a sell trade. Oh, let me check here my trade, because sometimes I miss the trades because I'm too focused here on the lessons. At least I take the trade on the euro this morning. Anyway, so traders here, it's a sell trade because look at the heading line, and that's the only thing we can do. Not the best trade, but this is what we can do. So what we are doing here is finding the end of this first leg. Then will come my favorite trade for the week. That is the buying the second wave. Or if the sell-off moves back to the lows or whatever, because that's what happened last week. Need to improve my prices. Wait a second. Okay. So last week, we were thinking that this would be a wave 1 and here the wave 2. But we need to sell it here. We didn't know that this was going to happen, but it happens, and we knew that it was going down. Right? That's the point. So that's the beauty at the end. So here, traders, we know that this could be a retrace, or what if the price loves, and actually we have a better price, that would be the best scenario, because I want to buy it. Let's see, we can do it before the Fed, and if we are already far away from the Fed, whatever, let's see. We don't want to trade during the Fed. Right? That's something that we don't want to do. But whatever, we want to buy it. That's the main trade. Of course, we don't want to buy the highs. So coming back here to the chart, we can see that if this is not the high, probably the next one. Right? Momentum still strong. On the MACD, the volume has been increasing. Look, prior to the opening. So it seems that it's going to be quite bearish. Now, the levels, let's have a look at the levels. So we got resistance at the 60, 65, 70, and the 80s. So the 80s is pretty close. Probably the price can go there. That would be fantastic. That would be the last level of liquidity today. It comes there, great. That's what we can do. I will share the trade in Discord if the price makes a fresh high, and we have a better place for the lines. That would be the best. Imagine later during the session, having first the divergence, price is slowing down and moving here to the 80s, let's say, and then rejecting. Wow, that would be just terrific. Let's wait a little bit more, but that would be mainly the trade. A retrace today. This is the Dow, the same storyline, but it's pretty cheap. You know, when we compare the S&P with the Dow or the Dow with the Nasdaq, clearly the Dow is in a deep discount. Look at the MACD. The MACD is like it's showing like the waves on the ocean. Right? When I see the markets, I always remember immediately the waves on the ocean. The same. That's why that was the analogy that was originally presented into the real life by Mr. Charles Dow. He said that the markets were moving exactly as the ocean. and as the waves in the ocean. Pretty interesting, that concept. Ralph Nelson Elliott, who discovered the Elliott wave theory, he was a huge fan of Charles Dow work, the Dow theory, and he said that, and he take all these concepts from the Dow theory into the Elliott wave theory. So actually, when you learn Elliott wave, you are actually applying principles from the Dow theory. Okay, so let's find the end of the Dow. The Nasdaq is so expensive, traders. Hopefully, we have a discount or something. It's so expensive, these markets. We knew that that was going to be the path during the next years. Probably tiny corrective waves and huge continuations on the stock markets. The Russell is in a deep discount as well, so it's an opportunity. The DAX, quite expensive, at least is showing a little bit of discount. Over the weekend, I cleaned up a little bit of wave count to have a better look. Instead of many extensions, I cleaned up for a clean wave 1 and wave 2. But again, in the stock market, if we have them, great. But we have to get ready for small corrective waves. That's going to be one of the key things that is likely to happen over the next years. Tiny corrective waves. The FTSE looks good, better than the DAX actually. It's long tails on the lower side. Momentum is like nothing compared to all the movement down in the MACD. Not moving almost at all, so clearly this is losing momentum. It's another way to see it. So of course this is the big guy buying. Volume is quite good, but momentum is quite poor, and the price action is bullish. It's absorption. It's bullish. The bond market, it's getting ready for the Fed not increasing rates. So the bond market believes that the Fed is not going to increase the rates. The bond market is showing inflation. And that's something that we can also see on the yields. The yields have been flying. The yields have been moving higher. The yields have been increasing their momentum. And what I believe, traders, is that this is wrong. So the 2-year yield is moving up, 10 and 30-year as well. This is wrong. I believe is wrong. I could be wrong. But I believe, traders, that the yields are going to sell off. If actually the Fed says that they are not going to decrease the rate, or they come with an aggressive plan to say that actually they need to increase the rates, let's say something crazy, of course, the yields will be right, and the S&P will fall, of course, and the dollar will continue climbing and all that stuff. So probably this is quite a manipulation, traders, from the big guy, the media. That's the sentiment of the markets. The markets are going in a direction where the inflation expectation is quite higher. If they are right, that only 10% of the times they are right, then we are going to have a sell-off on the S&P. But if they are wrong, as I believe, because I'm seeing the Fed in the inside adjusting their bonds for 25 basis points decrease, then we're going to have a big adjustment this week in the markets. And let's see if the noise, if the volatility, let us participate into the move. Because that's the other point. Sometimes the volatility, the noise is so complex that it's hard to stay in the trade. They want to shake out of the markets so the participants that are right don't make money. Right? Of course, the dynamics. So looking for the end of this leg down in the bond market. The dollar index is steady, but we have to be careful with the dollar trades because with the yields going up, the dollar can continue higher. And gold is a setup. Ideally, if it makes a fresh low, even better, because we will have a good divergence. That would be great. But our efforts this week are going to be bullish on gold, bullish on the silver. Here we have the divergence. Of course, if it makes a low, even better, because we have the stop in action here. But it doesn't matter. We're bullish, and we need to look into that directional move. Natural gas taking a pause in the trend. For now, let's keep the bullish bias. And oil has been moving down. So President Trump reveals that the plan in order to push inflation down is producing more oil in the US. So, because that was a question that I had before, because during the presidential campaign, they offered lower interest rates. Interest rates down, taxes going down. Of course, economy pushing up faster. But the interesting part is that they offered inflation under control, or probably even lower, right? They even said that the prices could go a little bit lower. So inflation quite steady with a trend to push it down. I was saying, okay, that's interesting. How they are going to do that? How you can move inflation down with lower interest rates and lower taxes and a stronger economy? I want to see that. I'm actually really interested in seeing how they plan to do that. Well, they are revealing a little bit more the details of the plan, and they are saying that this is by producing more oil. So oil increasing the supply of oil increasing, of course, price of oil selling, and they want to compensate. They want to push inflation down through the oil markets. Actually, that's quite brilliant. So in order to do it, they need to produce oil as never before. They need to start investing and doing a huge job in the oil industry to produce as much oil as they can. And now we are seeing the tool that they are going to use to stabilize the economy, to balance the economy, and it's going to come from oil. So something that is likely to happen then is oil aggressively selling during next year. Of course, they probably are not going to push oil lower than $50 because that's too cheap oil also is a problem. So there should be like a threshold eventually, but a $70 oil is not going to push inflation down. Of course not. So they need to make a huge effort to push oil prices lower. And that's their secret weapon for inflation, oil. That's quite smart, actually. Hard to do it? Yes. Because don't forget that the stronger economy is going to consume more oil. So demand is going to increase, and they need to push supply up as much as they can in order to overpass demand and push price on oil lower to push inflation down when they are decreasing rates and taxes. This is a pretty intense plan, traders. No, this is something new. We haven't seen something like this before, is that during an inflationary period, they are going to push down rates and taxes hardly and to control inflation, not through interest rates, but through oil. Wow, we have to get ready because 2025 is going to be an interesting year. We are going to learn so many new things of coming from this strategy that has not ever taken place before, pushing inflation down through oil and not inflation. That's exciting. I want to see that. I want to see it because we are going to learn so many things about this new methodology of having inflation under control. Is it going to work? We don't know. Probably. We don't know. No, nobody knows. But if it works, wow, it's going to be impressive. Well, let's see, right? Hopefully it works because, of course, it's going to benefit all of us. Okay, traders. So we have a clear plan for the week. We are looking for the sell trade then on the S&P. We're seeing the bias. Let's see if it makes a higher something that we can have a better entry point. The euro being careful already because we are seeing some concerns regarding the trend. So, of course, we have to be careful with those signals that we were seeing a second ago. And we will continue following these markets. Fed week. Have a fantastic start of your trading session. I'll see you soon. Take care. Bye-bye.